This is a weekly presentation of the Silicon Valley real estate market conditions for the week ending August 15th, presented Saturday morning, August the 16th. These are the key chapters. The timestamps are in the description below. Here's a graphical reminder of each chapter so you can jump to the ones that are most interesting for you. I'm Richard Calhoun, real estate broker with Creekside Realty. Contact information is here at the bottom of every slide. Let's get started. Here's a summary of the micromarket data. We're covering all of Silicon Valley, but Silicon Valley is made up of 3 counties, Santa Clara, San Mateo, and Alameda. Within each county, there's micromarkets. I have 7 micromarkets in Santa Clara County. I have 6 for San Mateo and 7 for Alameda, making 20. The green highlights up here are comparing the metric to the same week for the previous 10 years. So I'm taking this week, comparing it to August 15th data from 2015 through 2024. That's 10 years, doing a ratio, and whether it's better or worse. Better is pink for sellers. Slower is blue for slower marketplace, ice cold marketplace for favoring the buyers. And then the yellow are actual raw counts. So even though there's a lot of blue under the green, which says we're slower than we normally are, there is a fair amount of red and pink under the current market conditions. So even though we're slower than we normally are here in Silicon Valley, we're still not a bad market conditions. The orange ones are overbid. That's delayed by another 3 to 6 weeks to get the sale price, because you don't know if it was overbid until you know what the sale price is. So this is a lagging indicator. And then the last 2 are not favoring buyers or sellers, simply the appreciation since 2015 and the median price in the middle, the cheapest 10% on the left, the median in the middle, and the most expensive 90 percentile on the right. So in any micromarket area, you have a sandwich in what price ranges to expect. This is a quick summary just showing you the volume of transactions. The impact that's notable on this slide is that the purple, the current data line, is right on top of the blue, the least number of offers you'd expect. And we've been there now for 2+ years, and we're missing about 25% of the marketplace. So we're just having a lot less transactions in the industry, a lot fewer buyers and a lot fewer sellers. Here's the first summary slide showing inventory. Inventory started off a quarter ago with a surplus. You had more inventory than the most inventory you'd expect. You were 34% more inventory than you typically have. The typical is the gray line. Again, the red would be less inventory favoring the seller. Blue would be a lot of inventory favoring the buyer. In the center of the table is this week, and that's where the purple line stops, because you don't have data into the future, but you do have trend lines into the future, because the past 10 years do exist for the future weeks. So this gives you an indication of which direction the market is likely to go. It could go in any direction, but the direction it's likely to go would be continuing along whatever line it's on. So if it's on the gray line, it would probably follow the gray line. If it's near the blue line, like the offers accepted, it will probably continue along the blue line. But you can see there's significant weeks of variation where here it was following the blue line pretty closely and then abruptly changed, and then it changed again and was now right on top of the gray line. Moving on to offers accepted, you can see that we've been following right up on the blue line. We started off at 77% of the offers accepted you'd expect. We're now at 78%. We're selling 2,000 homes in 5 weeks instead of 2,570 homes in 5 weeks. Transactions closed. This is sort of noteworthy. Normally, you'd expect transactions that are closed and offers accepted to be roughly going at the same ratio. That would be the same rate of TFT. Here you can see that they matched exactly. Now, they're not going to match up exact because there's a time shift. Remember, escrows closed 3 to 6 weeks after the offers accepted. But now notice the huge difference over here. You're almost missing 7.5% more of the transactions. That may suggest there's going to be more transactions falling apart. It may just be a 1-week dip and we may be back up next week. There's really no way to know, but it's interesting that there's such a significant difference right now. And you can see that the purple line down here on transactions has been pretty much following the blue line. If you go back 3 to 6 weeks, there was no dip down. So that would tend to suggest the number of transactions that are failing has increased. That does tend to happen as the market slows down, because the buyers don't feel the pressure to continue with the transaction. They feel that they can go out and get an equal or better buy in a couple weeks or a couple months. Moving on to today's unsold inventory, this is the seller buyer, the balance, the buyer supply demand balance, the turnover rate of the marketplace. You can see we've improved slightly from 52 days down to 49 days, but we've had a more significant improvement compared to normal. We were at 71% slower than normal. Now we're only 23% slower than normal. So yes, the market is slower than normal, but it's not as slow as it had been, and it's still reasonably quick to sell all your existing inventory in 49 days. That's just 7 weeks. Marketing time, that's a similar measure. It's how long does it take 3 out of 4 sellers to sell? We were taking 33% longer than we typically do. That's the ratio between the purple line and the gray line. We're now at 45% longer than typical. So it's quite a bit longer now. And so the market's continuing to slow down. The typical is 24. The longest you'd expect is 39. We're 34. When you start going from typical to longest being only 5 days and you're 5 days above that, that's pretty significant. Look at the vertical separation. Look how much above the blue line you are. It's going to be another week or two, and I'll probably have to expand the graph to fit on the purple line as it continues to go up, most likely. Price reductions are the price reductions the seller takes prior to getting the offer. So they go on the market, they do the research, they go on the market, they have certain expectations when they go on the market. The market then rejects them because their expectations were out of line with reality, and they do a price adjustment. So price adjustments were only 1%, which is really trivial. But the reason that number is so small is only a small fraction of the sellers do a price adjustment. And that 1% is 2.5 times bit larger than it normally is. So the normal number would be somewhere around 0.4%, was all the reduction you'd expect. And that's 13 weeks ago. We're now taking 1 2/3% reduction, and that's actually less of a percentage basis. It's only 72% more. So we were taking larger than normal price reductions before, and you can see that you were below the blue line, and now the blue line's caught up to the purple line, and the purple line the last couple weeks is actually slightly above the blue line. So you're now within that 90% range, and in a soft market, you can see that you should be taking 1.72, 1 3/4% price reduction. So you're doing slightly less price reductions than a cool marketplace. Overbidding, and this is just the raw magnitude. Typically, you would have expected 7.6%, and we were at 6.8, which is why the purple line is slightly under the gray line. But now fast forward to the current week, and you'd expect to be at 5.9%, and we're only at 3.1%. So that's almost 3 percentage points less overbidding. It's 2.8%, so 2 3/4% less overbid on when the buyers come in with their offer. The buyers are clearly not feeling the pressure to overbid as much as they had been. Now we're looking at 3 key indicators over a long period of time. We go all the way back to January 1st, 2015 to January 1st of 2024 is on a condensed scale. You can see how close together the year vertical lines are. Boom, boom. Once you hit 2024, you expand out, and now your vertical year line takes up twice as much horizontal distance. And that's so we can see trends a little bit better. What are we looking at? Purple is current inventory. So inventory is just a tad below 100%. I believe the number was 99.1% of the inventory you'd expect. So yes, we did have a surplus inventory earlier this year. We got up to 38% more inventory than you'd expect, but now we're right back down to normal. So the market's already adjusted. There's a typical level of inventory. But now let's move on to offers accepted, the orange line down here at the bottom. You can see we're only at 78% of the offers you'd expect. And you can see that we've been down there not just for 2 years, but for almost 3 full years. Basically, you could say somewhere starting right here, third, fourth quarter of 2022, you hit there. So 1 year, 2 years, 3 years. So 3 full years, we've been missing 25% of the marketplace. The rush after the pandemic, yes, we had a surplus, but if you draw that out at 20% surplus, it only lasted for maybe 2 years. So you're losing a greater percentage for a longer period than we gained after the shelter-in-place order. And the more key indicator of the 3 is the days of unsold inventory. You can see that we're slightly above, we're 22% more. That's saying that this would take longer, the turnover rate is slower, homes are staying on the market longer. And you can see that except for shelter in place, up here was basically a record slow in the last 10 years. Here's the shelter in place peak. So the previous peak was 60% slower than normal. And we spent the first half of second quarter above that level, and we've been improving ever since. Now let's look at inventory. This is inventory, but the typical line is the gray line. The least number of inventory you'd expect is the red line favoring the seller. The most inventory you'd expect is the blue line up here. You can see that we were down in the red area, so a shortage of inventory at the end of last year, beginning of this year. But this year we rapidly climbed. First quarter we were climbing, and we were climbing faster than we normally do. So during the first quarter, you went from the red line to the gray line to the blue line. Then second quarter, we basically stayed on the blue line. But now that we're in the third quarter, we have fallen down fairly rapidly and caught up to the gray line. So we're back to that 99% of the inventory you'd expect to have. Here it is on a percentage basis, and you can see the run up here. And yes, there was a bigger run up in the last half of 2018, early 2019, but early in 2017, Santa Clara County only had a double year appreciation. We had the typical run up in February, March timeframe, and then we had another one in August. And so we paid the price later in 2018 and early 19. And the other two counties, Alameda and San Mateo, really didn't participate in that fluctuation, but it showed up here when you put all three counties together. Now you can see roughly the same spike, but again, we're back to normal. So when was the last time we had normal inventory? Basically, if you look at this, yes, the normal is there, but that's the 10-year median. We never had a normal level of inventory. You either had a shortage of inventory or you had a surplus. You're not on this gray line. The gray line, which would be 100% normal, is really unstable. And yet now we've been there for basically 1, 2, 3, 4 weeks. We've been there for almost a month now, which is actually a long time when you look in the past 10 years. Another way of looking at it is typically when you're at the gray line, you're climbing or you're falling each time. You're rarely at a plateau like we are this time. Here's the offers accepted compared to the 5 weeks. You can see that we're essentially at the least number of offers you'd expect. Yes, you can get lower than that, and you were lower than that back here in third quarter of 2024. Earlier in second quarter, we were actually selling a little bit more, but we were nowhere near the normal level, which again is the gray line. Here's on a percentage basis, and you can see even though that previous graph was all over the place, this is pretty stable, somewhere right around 78, 78, 80% of the level of inventory you'd expect. Yeah, there's bounces, but it's been pretty constant. If you came back, you'd say 2023 was probably 70%. And then I would actually say pretty darn close to 78%, right about the level we are now for all of 2024 and all of 2025 so far. Here's looking on a percentage basis. You can see the climb up, right tracing. And here you can see right the last month of first quarter, we pulled away and we actually had slower than the slowest days of unsold inventory that you expect as indicated by the blue line. Now here's the percentage of normal. You can see the spike up. Even though we've improved significantly in the last 10 weeks, we're still at almost record high levels. Not quite, but you're above average for the past 10 years. So the market's slower than it typically is based on the past 10 years, as well as based on the specific week for the past 10 years. Here's your marketing time as measured by 3 out of 4 sellers selling. This is interesting, and I have no explanation, and no one's volunteered one. And if you have an idea, I'd love to hear it. But notice the peak. If you look at the peak, whether it be on the red line, and the red line's the hardest, the gray line or the blue line, it's happening right after first of the year every single year. And the purple is basically corresponding. This year, we had a shift. The peak of the purple was basically the last week in 2024. We came down, and the bottom, instead of being midway through second quarter, was midway through first quarter. And then we climbed rapidly, but notice we're having a downward trend. We typically don't have a downward trend until somewhere in fourth quarter. So the fact that the marketing time is now improving is unusual. Whether this is a 1 week fluctuation where more listings sold last week that were shorter time on the marketplace, it's hard to tell. And this does only include those sellers that are successful in selling. It's not looking at marketing time of the listings that are on the marketplace, which includes the properties that are overpriced or otherwise not going to sell. Here's compared to typical. So you can see that even though it was a little bit higher, and I actually expanded this graph, it used to cut off at 170%. So down here, it now goes up to 200, so twice as long. But we've actually been improving the last several weeks, basically since July 1st. So all of July and August has seen a decrease in marketing time. But look at how much we climbed. But notice it's also very similar to where we were in February of 2022. We climbed, and then we did a little improvement, and then we did a roller coaster. So whether we will do a double dip, or I would expect a dip coming up. Well, actually, you don't expect a dip when you're seasonally adjusting it, which is what this is doing when you compare to typical. Now what we're doing is we're looking at the sellers that are taking the largest 10% price reduction. So you put on, it's the 90th percentile. What seller is the 90th percentile? Only 1 out of 10 sellers takes a bigger price reduction, 9 out of 10 take a smaller. They're right now taking basically a 15% price reduction. So the sellers that do take a price reduction are taking significant price reductions. but still very few sellers are doing price adjustments. You can see you're below where you typically are, and it's the vertical separation way below where you'd expect to be. So bigger price reductions than you'd expect. Here's on a percentage basis, and you can see we're up here in the blue. We're not at record high, but we're sort of on the higher ends. 2022, 2023 was higher, and 2018 and 2019 were higher. Other than that, we're pretty up there. So time-wise, the amount of times that we were higher than this is not that many. Here is the average. So now this is just to show that I'm not playing games by showing the 90 percentile. I like the 90 percentile because something like 20% of the sellers do the price reductions, 80% don't. So why add in a bunch of zeros? When you do that, 15% on the previous slide drops down to 1.6%. So it sounds like a small number, but that's because the vast majority of the sellers price their home to sell at the ask price. Here's the percent of normal. You can see that you went down quite a bit further, and now we've been improving. And right now you're at reasonable levels, but you're below what you'd expect. So the amount of price reduction is greater than you'd expect. This is the frequency. So how common is it? Right now, only 22% of the sellers are doing price adjustments. That means 78% of the sellers that are selling their property are not adjusting their price in order to get that offer in the door. Here's compared to normal. So you can see we were actually hotter than normal just earlier this year, less price reductions. Then we increased, and we were up there sort of at the 3 time slots that are record high, 2018, 19, the shelter in place crash in February 2022, and then right now. And so it's as the market is going down. So here you can see the run up. As the market's going down, the frequency of price increases really increased because the sellers weren't expecting the market to go down. That's what really is happening here. The sellers and buyers weren't expecting the market to go down, so they priced their home optimistically and they had to adjust their price. Now they're starting to see that the market isn't so good, so the number of sellers that are doing price adjustments is decreasing because they're doing the price adjustment when they come on the marketplace. Here's the magnitude of overbidding. So this is delayed by 3 to 6 weeks to get that sell price. You can see that we're below the least amount of overbidding you'd expect. This is median, so this is half above and half below. We're almost right at 100%, which is not necessarily even where you'd expect it to be. In most areas of the country, sellers get less than their ask price. The less, Silicon Valley is unique in the fact that the list price is sort of a floor for the most part, and you go up from there, not go there and negotiate down. But, of course, there's always the exception of the property that's priced correctly that you may not be able to negotiate down. It all depends on who's competing against that one buyer that comes in with the offer. But you can see the maximum overbidding happened right at the end of first quarter, beginning of second quarter, and then we were up at 6%. So half the buyers were paying more than 6% above, and half were paying less than 6% above. Now it's basically down at 100%. So half the buyers are paying over ask price and half are under. And I think the number was 52% are paying over ask price. Here's the raw count, and this is still median. But this is now saying that your amount of overbidding is 3% below where it normally is. So right now you're essentially at 100%. So normally at this time of the year, you're overbidding by 103. And if we were at 103, we'd be right here on zero, saying it's exactly typical. And again, you can see this number is rarely at the typical level. And when it's near the typical level, it's either racing up or it's racing down. So we race down and we do a plateau down here. So this is where you have the sort of stable, cool marketplace. Here's the frequency of overbidding. So how common is it? And you can see I was correct. Just a hair over 52% of the sellers are receiving more than their asking price. And that's actually less than you'd expect. What you'd expect is way up here at something like 68% of the sellers. So you're missing about 16% of the sellers, 16% of the fewer sellers getting more than their asking price. Here it is on a percentage basis, and you can see we're declining, just like we declined in February of 2022. Straight down, and we kept on going down. Here's now a price model. This is on log paper, so you can draw a straight line through that, and that's your compounding interest rate. So you can say that we went up at 12.1% for 7.5 years, and we've been flat ever since. That's probably a pretty accurate model and becoming more accurate as we're already seeing the purple line is below where you'd expect to be. So what's that saying? It's saying we're below the peak pricing in 2022. And if you drew a straight line, you'd actually even be off by more because you'd be up by the peak. So I think this two-step is more accurate. And, it's fairly unusual in Silicon Valley to have a period of 3 years with relatively flat prices. Yes, if you bought right at the end of 2022, beginning of 2023, you were below that. And you also have to look at market mix and everything else. These are not, median price does not reflect property values, and we'll see that in the micro market data. Now we're looking at three distributions. The first unique distribution is days on marketplace. And this is why a good demonstration of why I don't use median. This is the 50 percentile. This is median. Look how little that changes throughout the year. It just barely moves. I selected the 75th percentile up here, which moves quite a bit more. Having the knowledge that I have now, if I had that back in 97 when I started doing this, I probably would have picked the 85th percentile marketing. And what we're doing is we're looking at every transaction, but we're only looking at those between 50 and 90%. Above 90% is basically noise and not really where the market is, and fluctuates a lot more. And we step off, we do 1 week at a time initially for 5 weeks, and then we go 2 weeks. So you're starting off on the dotted lines, which are the old lines a year ago. And you can see you're really not moving anywhere. You're just sort of bouncing up and down. And then right around the middle of November, right about there, you start racing up. And right there's the peak. December 27th, this is the slowest of the market, the longest marketing times. You rapidly notice how steep the slowest one is. And that's why I marked that the slowest, or the hottest. Even though it got hotter here, it's mostly the top end dropping down, which is getting rid of the overpriced turkeys. So that's why I do the steep line. Now you can see the solid lines. And, right now you're just bouncing around just like we started off, and that's what you'd expect. But notice that we're quite a bit cooler than we were a year ago, and we're actually getting towards some of the coolest lines. There's basically only 3 lines that are significantly cooler than we are here. So this is some of the longest marketing times, and we're not to the longest marketing time. So I would expect this to bounce around, and I expect when we get to these years in December timeframe, we're going to be up here between I don't think we're going to get to the blue line, but we'll be above the current dotted line data. Or another way to say the same thing is the current purple line is basically the worst line in the recent past, and significantly higher than we were a year ago. Here now is doing the same thing with price reductions. And again, you can see that especially on the side of the sellers that are doing the largest price reductions over here were the most. Now, when you come up here, it's not so clear that it's the worst. There's about 4 or 5 lines down here that are taking larger price reductions. But you can see that across the board, the dotted line is where we were a year ago. So, and I'm not comparing the median, I'm just doing 1 year. I'm doing 53 weeks back. So this week, this week on the purple and a year ago's week, you'd expect it to be the same. But across the board, it is a larger price reduction by several percentage points. We're going from something like 94.5 up to about 96.5. So sellers sort of across the board are taking a 1.5% additional price reduction. Here it's almost 2.5%, because you're at 92%, 91%, 90, 85, 89.5. So 2.5% more price reductions on the upper end. And even at the fast end up here, and I only go to 17%, and that's because, remember, I forgot what the number was, 78% of the sellers do no price reduction at all. So on the upper end here, you're 1, 2, 3, 3.5% larger price reductions. So clearly more price reductions than you normally have. Stepping through, you can see that you have, similar to days on market, it sort of just fluctuates around and really doesn't go anywhere for a while. We're in the beginning of November now. It's starting to cool down. Right there was a big step. Now, right this middle of December, right there is sort of the slowest, and December 27th is also pretty slow. And now you're heating up, and in 2 months, you heat up to the hottest, the least amount of price reductions. That's only February 21st. Then you improve with more and more price reductions. More and more price reductions. Now you can see for the last several weeks, but look at some of those big jumps down that you didn't have. So now you're floating around at the lowest level. You're clearly, again, larger price reductions than we were a year ago. Here's the buyer's overbid, and the same concept. Notice the purple is actually the coolest line on here. So in the last 53 weeks, buyers are overbidding less this past week than they have in the past 53 weeks. Here's where they were a year ago. You can see on a percentage basis, that's 5%. So that's about 2.5% right through here. Up here, it's probably getting closer to 3 or 4%, probably 4%. So it's fairly significantly drop in overbid from week to week. But we'll step through and watch it. Again, it's stable. And because we have to do closings, which adds in 3 to 6 weeks, instead of the market shifting middle of November like it did for the previous 2 data points, it's going to be more like the middle of December, right about there. Yep, December 13th to 27th. There's the bottom on January 24th versus the end of December. Then you're already accelerating. Look how quickly that comes up. By March the 21st, if not 22nd, you're already at the peak. And there was about 3 weeks at the time. And that's actually, this is a time frame when it was 2 weeks. So there's actually 6 weeks when we were getting the most overbidding. And that was basically middle of February through the middle of March. And so here we are on the current line, and that's the lowest line on this whole graph. So we're having the least amount of overbidding in the past 53 weeks. Now we're looking at the 3 counties. We'll start off with San Mateo County, smaller county down here with only 525 listings roughly. But notice just a couple weeks ago, a quarter ago, they were up here at record high. They've never in the last 10 years had 600 active listings. Santa Clara County, so they had a surplus of inventory. Santa Clara County is still short from where it was pre-pandemic. Pre-pandemic is basically here in 2022. You had larger inventories, so we're shortage in Santa Clara County. Alameda County is basically right back up there with those previous levels. So Alameda County has normal levels, Santa Clara has a shortage, and San Mateo County has a surplus of inventory. Here's offers accepted. Right off the bat, Santa Clara with less offers is now outperforming Alameda County in the number of offers accepted. So Santa Clara County is going to have a much faster turnover rate, DUI, than Alameda County. And you can't tell right off the bat with San Mateo County, but we had record high inventory right here, and we did not have record high offers. So here is the days unsold inventory. You can see that Santa Clara County is the fastest, selling out the marketplace in about 41 days, followed by San Mateo at about 48 days. And the slowest is Alameda County at something like 57.5 days of unsold inventory. Here's marketing time. And now, again, the order is very similar, but not exactly. And this is the time it takes 3 out of 4 sellers to sell. So in Alameda County, it's taking 37 days to sell for 3 out of 4 sellers to sell. In Santa Clara County, the blue line, it's 32 days. And in the San Mateo area, it's about 30.5 days. So just over a month. Call them both a month. Here's the price reductions. So this is the sale price to list price. Look at this huge drop in Alameda County. And you had a huge decrease in San Mateo County. That's pretty bizarre to see something like that going in opposite directions. And, these are, if the media was talking, they'd be talking about the Bay Area pricing. How do you do pricing with the versions like this? Alameda County went from something like 98.3% down to 97.9%. That's about a 0.4% price reduction. And these are the sellers' price reductions. Meanwhile, San Mateo County went up, and it went up even more because that's almost 0.5% decrease in the amount that the sellers were reducing their price. And Santa Clara County was more stable and slightly reducing the amount of price reductions. So both in Santa Clara County, a slight decrease, huge decrease in the sellers reducing their price, a huge increase in Alameda County. Here's the frequency, and the drop in San Mateo County could easily be attributed by the frequency. We went from 22% of the sellers doing a price reduction to basically 15. That's a 7% drop in the percentage of sellers doing a price reduction. You can see Santa Clara County is much tamer and flat, and Alameda County isn't going up outrageously like San Mateo went down, but it did go up a little bit last week. So in Alameda County, it's the same number of sellers taking larger price reductions, and in San Mateo County, it's fewer sellers taking the same amount of price reduction. Here's the overbidding. You can see Santa Clara County has the least amount of overbidding. San Mateo County is close. And Alameda County, with its longest marketing time and largest price reductions, is having the most overbidding. The only logical explanation is the buyers are waiting for the sellers to reduce their price. When the sellers reduce their price below the market value, the buyers go in and pounce on them and overbid the ask price because they're at least afraid of having multiple offers. Here's the frequency of overbidding, all very close together, 52 to 54%. So still more than half of your sellers are getting overbid when they do get the offer coming in the door. Here's long-term appreciation. Santa Clara County has the most appreciation. It's something like about 92% appreciation maybe. And then the San Mateo and Alameda County are very close together, about 65% appreciation. Here's the long-term pricing. You can see the San Mateo County is slightly more expensive now in the normal order than Santa Clara County, but fairly flat. And here you can see each county reasonably at the same level all the way back to, second quarter of 2021. So we're clearly not having rapid appreciation, and buyers should not feel pressure to move quickly. Santa Clara County is doing a little bit better than San Mateo County. You can see there's a slight increase, and that's sort of why I drew the lines. See, if you come back here at the peak of 2022, San Mateo County is down significantly, where Santa Clara County is only down a little bit. Alameda County is down significantly. Here's the exact same information on regular paper. The previous was on logarithmic paper. And here's the estimated payments using the national average for high balance conforming loan limits. So you can get lowered by just doing a jumbo loan. And then if you have stock, you don't have to sell it, but you can have potentially get relationship pricing with the banks. Here now we're looking at the micro market areas. The first one is active inventory. This is comparing inventory to the levels of the previous 10 years because just raw count of inventory doesn't tell you anything. Blue favors the buyer, red favors the seller. You can see there is more blue than there is red, but it is interesting. It's sort of the expensive west side of Santa Clara County where there's actually a shortage of inventory, 63, 83, and 77%. Most of the other parts of the valley are either balanced or slightly favoring the buyer. The San Mateo County is more favoring the buyer, and Alameda County is more balanced at 96% of the inventory you'd expect. Moving on to offers, here is where you're really seeing across the board shortage of offers. But even having said that, Los Altos has 9% more offers than it typically does for this time of the year. And that's based on the last 10 years. So there's one area that's doing more than normal, and I don't see any other 100%. Silicon Valley overall is at 78%, so you're missing that 22%. Alameda County is only at 73% of the inventory, the offers you accept. And for the first couple slides, I only have countywide data for Alameda County. Here's the days unsold inventory, the turnover rate of the marketplace. Here, a high number is slow. So you can see Santa Clara County. Well, first off, there's no red anywhere. There's some white areas. So your Saratoga, Los Gatos, your Cupertino is basically balanced. Campbell is a little bit slower than normal, but Los Altos, Palo Alto is a little faster than normal. So even in this marketplace, there was an area that's moving quicker than normal. So the previous slide was days unsold inventory compared to the 10-year median. Here's just the raw count of days unsold inventory. So you can see there's areas like the affordable areas in South Alameda County are the slowest market areas right now. The fastest is Cupertino at 23 days. So the red are fast, blue are slow. And so you can see the areas where the market's slowing down or taking the longest. And this is the turnover rate. How long does it take to sell your existing inventory versus marketing time, which is coming up next. So here's marketing time compared to the 10-year median. So you can see that Cupertino Sunnyvale is doing a lot better than normal, only 61%. So sellers are selling in almost half the time that they typically do for this time of the year. Campbell, though, is 150%. So fairly significant difference, and that's a little leeway. You look at Berryessa and Milpitas, 73% slower than normal. Come down to Alameda County, Oakland at 224%, Pleasanton 160, Castro Valley at 167. So the areas that are blue are taking longer to sell, 3 out of 4 sellers to sell than they typically do. The red areas are taking less time to sell, and the white areas are basically right at normal. Here's what the raw counts are. So, look at Cupertino Sunnyvale. In 11 days, 3 out of 4 sellers sell. Even in Morgan Hill and Gilroy, South County, 48 days. So that's basically 7 weeks. So 3 out of 4 sellers in one of the slower areas, they're still successful in selling in 7 weeks. This, again, does not count the sellers that try and aren't successful in selling, because I'm looking at data that went pending to get days on market. How long is it going to take to sell a property if you don't have an offer? It could be forever. And so that's why I'm not excluding it to make it look better. You don't have a definitive answer. Moving on to price reductions. This is compared to the normal, so much bluer than normal. But even with that being said, look at San Mateo County. Several of the areas, 3 of the areas are bright red. And here in Santa Clara County, one of the areas, Cupertino, right now is bright red. Sellers are taking less price reductions than they typically do. Down here in Morgan Hill and stuff, in Central San Jose and Milpitas, they're taking more price reductions than they typically do. Here's the average magnitude. Notice how blue it all is. So sellers are taking fairly significant price reductions. The numbers may look small, but they're bigger than they typically are. Here's the frequency compared to the 10-year normal. So look at Cupertino. Only 45% of the sellers are doing price reductions that normally do. Saratoga, Los Gatos, right at 100% of normal. Foster City, 0. So I guess that must mean that no sellers are doing a price adjustment. Then you go into Alameda County. Look how much blue there is in Alameda County. So clearly you can see the areas where the price reductions are happening more frequently than normal. And that's what we were saying earlier. They're doing more frequent price reductions, but they're actually having aggressive overbidding because in part because of this amount of price reduction. Sellers are reducing their price to below market value, and then the buyers come in over ask price. Here's the frequency of price reductions. In Cupertino, Sunnyvale, you're only having 6% of the sellers doing a price reduction. Here it is, 0% in Foster City. You can't get better than 0% of the sellers doing a price adjustment. Berkeley and the island of Alameda at 8.8, 8.7 days. Who's got the most price reductions? Well, it's got to be blue. So right here, Castro Valley. So almost a third of the sellers are doing a price adjustment in Livermore, Castro Valley, and Dublin. Here's the overbid. This is what the buyers come in, and this is compared to the 10-year median. So this is where you're taking less overbidding than you normally do. You can see Palo Alto and Los Altos are taking a little bit more overbidding. The blue would be less overbidding. Look at Livermore, look at Castro Valley, look at South County, look at Milpitas, look at Redwood City. You know, some of these numbers are pretty high. And, you know, they may not sound like high numbers, but you have to have some understanding. Oakland, 94, 96%. So this is the amount of overbidding compared to the 10-year median. Here's actually what the overbid is. So in Oakland, you know, that's actually a great example. Here in Oakland, they're taking 6% less than they normally do, but they're still at 7%. Berkeley and the island of Alameda, 16% overbid. This is the raw number. The area where they're doing the least well is in Pleasanton, where they're taking a 3% price reduction on the offer. So at the time the offer is submitted, they're knocking off 3% on average. Here's the frequency of overbidding. So how common is overbidding compared to the 10-year median? The only area that I'm seeing right off the bat that where it's more, well, there's 3. There's Saratoga, Los Gatos, Los Altos, Palo Alto, and the Atherton, Menlo Park, the expensive areas in San Mateo County. They're actually having more overbidding in the expensive areas. So right through here, and I guess sort of right through this section here, is where you're having the most overbidding and more than typical. The rest of the valley is having less frequent overbidding, and this is frequency, not magnitude. And then here is the actual raw numbers. So let's look at Atherton, 38% of the sellers. So, you know, 38% is a low number, but it's still more than it normally is. Saratoga, Los Gatos is at 48, Los Altos is at 56. So those numbers are not that outrageous. You know, there's times when, well, even right now, Cupertino, Sunnyvale is at 73.4%. So you have to compare raw count to get some idea what you're talking about, but it's also real estate is very cyclical. So it's important to compare it to where it normally is for the same week. And that's why I'm doing these back and forth. I believe the 10-year comparison is more important, whether you're hotter than colder than you typically are. And then to ground yourself, because we're such a raging bonfire, you look at what the raw counts are. Here now is the appreciation, and something that's still apparent but becoming less apparent is in Santa Clara County, you had almost 93% appreciation. But when you look at each one of these areas, no one area had 93% appreciation. So how does that happen? Simply by having more activity in the expensive areas. If you have more activity in Los Altos and Palo Alto, Saratoga, Los Gatos, Cupertino, Sunnyvale, and even in Campbell and Santa Clara, Willow Glen, you're going to be pulling up the median price for the county because those areas sell above the median price, but you're not going to be pulling up the median price for those micro market areas. So the micro market area appreciation is much more accurate than the countywide data. And you can see the same thing in San Mateo County. The highest number I'm seeing right off the bat is 56%, but yet you had 64% appreciation. Now that is not true in Alameda County, where you're at 69%, and yet almost every area except for Oakland and Berkeley has had a higher appreciation than the 69. So you have to look at market mix. That's why I'm looking at micro market data, and that's the importance of a CMA when you're actually trying to determine values. And then the media takes it this whole step further. It puts 9 counties that touch the Bay into the Bay Area and talks about what's happening there. And that's just a total garbage number. You know, if I can't even make sense out of the numbers here in Santa Clara County agreeing with the county number overall, you're farther off. So that's why the micro markets are so important. They're similar priced homes, they're similar geographical, and they tend to perform much more uniform than a county. Here now is the median sold price in the middle that most folks carry. On the left-hand side of that is the cheapest 10 percentile, and on the right-hand side is the most expensive 90 percentile. So in every area you get a range. So Santa Clara County median price is just under 1.6 million. So any area, anytime you have a sold price over 1.6, it's going to raise the price. So anything in these last three micro market areas, Cupertino, Sunnyvale, Saratoga, Los Gatos, Los Altos, Palo Alto, is going to bring up the median for the county. Any transaction in East, Central, or South San Jose, because the 90 percentile is 1.5, which is lower, we tend to pull down the market. So what you're having is a decrease in this area, an increase in these areas, causing the median price for the county to go up more than property values. San Mateo County, I'm not seeing anything really noteworthy. And then the Alameda County is blue, not because it's favoring the buyer, but because it's the more affordable county and the lower price, and blue is based on price. Here's a summary of what we went over. So you got a summary chart, and again, the green is the 10-year comparison. The yellow is the raw median count for the raw data count for the data point. The orange are lagging because you need the sold price, appreciation, and sold price. Here now is the sales volume, and notice now we actually have up to 5 weeks in a row where we're the 24th slowest number of transactions out of the last 25 years. Only 1 year was lower, and the year that was lower is 2023. Now, granted, the numbers are pretty close. 2009 versus 2000, 1938 versus 1962, 1979 versus 1948, 1985 versus 1993. And we may have one more still fall here because we're at 2039 and we need to get down to 2033. And, this is still early enough that transactions may fail. And even here, you're only off by 20 listings. 2117 versus 2097. That's only 20 listings. That's 1%. We lose 1%, which is starting to get unlikely. We'd have another year. Basically, we're having a lot of years. When you start seeing 23s and 24s out of the last 25 years, that's pretty significant. And up here, you're comparing to including the pandemic. So this was all pandemic-induced low volume of transactions. In a lot of ways, the lack of volume is the real story, and no one seems to be talking about that. Here's the raw numbers for Silicon Valley overall, Santa Clara County, San Mateo, and Alameda counties. You can see that we've had a drop in the number of new listings this week, fairly significant drop. We've had a smaller drop in the active listings. We've had an increase in the number of offers accepted, making a fairly significant drop in the days of unsold inventory. This is an improvement. Negative numbers are decreasing the volume, decreasing the time it takes to sell, the turnover rate. And I consider 5 days to be significant. 3.5 is getting pretty close. It's actually, frankly, a little surprising, but it could be just a statistical fluctuation of a week. We've been talking about the Silicon Valley real estate market. We will be talking about the Greater Bay Area, 13 counties, 5 regions next. I'm Richard Calhoun, real estate broker with Creekside Realty. My contact information representing buyers or sellers here in Silicon Valley up to about and a little beyond 580.92 is sort of my typical cutoff. I don't go into San Francisco. I dabble a little bit in Contra Costa County, but not very much. The YouTube link is up here is the blue URL. I also can type in the green root URL. It's shorter typing, gets you there. If you want to get any presentation live, you type in the green root URL, 2025, Saturday morning at 9 o'clock, and I do the presentation. If you want the handout, it's 73 pages this week. You type in the green root URL, the letter H, 2025, 08, 16 for this week. And this week only, you type in 17 instead of 16. I posted bad data on 16. So type in 17 and type in tomorrow's date, not today's date. Sorry about that for anybody that uses that. And then any past episode, you can type in the green root URL and the year, month, date code and go directly to there. I appreciate likes and subscriptions. Let's get into the Greater Bay Area, 13 counties, 5 regions. Here are the 5 regions. We've been talking about the first one, Silicon Valley at length. Then you have the cities, San Francisco and Marin, North Bay, Solano, Napa, Solano, and Contra Costa County, Central Valley, San Joaquin and Sacramento, Central Coast, Santa Cruz, and Monterey. Here's active inventory. You can see active inventory is going down in all 4 out of 5 regions. It's basically flat in Santa Cruz and Central Valley or Central Coast. Here's the offers accepted. Notice the increase. All the areas are sort of increasing the number of offers, and that sort of corresponds with this dip that normally happens. August is sort of a low time for closings, and then we pick up again. The same thing's going to happen this year, sort of not what you'd expect, but what typically happens year after year. Here's days unsold inventory, the turnover rate dropping in all areas. So the market's accelerating. So we're starting to get more offers. That increases the speed turnover rate. Here is the marketing time rolled over in Silicon Valley, flat in the other 4 regions. So I'm not sure which direction that's going. My speculation is it's going to go down a little bit next week, but there's no way to know. Here's the ask price reductions. This is going down, which is an actual increasing in price reductions. Up here is 100%. That would be no price reductions. And yes, there has been times when we've actually had sellers increase the price on average above the seller's original ask price. Typical is right here. That's sort of where you'd expect it to be. And as you get further and further down, the price decreases are more. Central Coast is the most at 2.8%, and Silicon Valley is the least at 1.6%. Here's the frequency of seller price reductions. Central Valley has the most at 40%, and North Bay is right there at 39% of the sellers are doing price reductions. Then you have the Central Coast at 33%, the cities at something like 27%, and the least amount of price reductions is Silicon Valley at something like 21% of the sellers are doing a price reduction. This is the average overbid. Central Coast is 2% below, North Bay or Central Valley is 1% below, and North Bay is about 0.25% below. Silicon Valley is up here at 3%, maybe 3.25% below above the seller's ask price. And then you have the area that's doing the most overbidding right now, the cities in Marin and San Francisco at something like 7.5%, 5.75% over the seller's ask price. Here's the frequency. So even though the cities had a larger price increase, Santa Clara County, Silicon Valley has a greater percentage of the sellers getting more than their overprice. They're very close together, 51 versus 52%. The area that has the least amount of overbidding is the Central Coast, North Bay, and Central Valley are in between. Here's the long-term appreciation. The big takeaways are the cities has the least appreciation. The Silicon Valley had the best appreciation until recently, and I think that's just because of the market mix. Santa Cruz is coming up and now having the best appreciation rate, but again, I think that's the type of properties that are selling in the Central Coast. Not only do you have the coastal communities like Monterey, Pacific Grove, but you also have the inland cities. You have Salinas, you have Soledad, you have the 101 corridor in the Central Coast area that can, if that's being more active than the coastal properties, that really impacts your median price and your appreciation. Here are your actually sold prices. You can see Silicon Valley is more expensive this week than the cities. That does happen. It doesn't typically happen, but you can see it happen many times in the past. Historically, the cities of San Francisco and Marin would have been more expensive. Central Coast is in the middle position, North Bay, and the most affordable is the Central Valley. And if you wanted to see prices flat, look at Central Valley. Basically, you peaked in early 2022, and you've been basically flat ever since. The price is lower, so if I change the scale, it would fluctuate more, but talk about level pricing. Here's the estimated payments using the same Freddie Mac national rate for high balance conforming loan limits, which you can do better interest rates locally by doing a jumbo loan and relationship pricing with the bank. And here is the actual raw numbers for the current week is the now week, 1 week ago and 5 weeks ago percent change, so you can see which direction the market's going. You have all 13 counties down the left-hand side here, plus all the 5 regions. I do throw in the Bay Area media just because the media talks about it. And I think it's a complete garbage number, as I do, frankly, think the county numbers are garbage numbers. If you're trying to determine what the particular market's doing, you have to look at the micro market areas. And again, with that, we're back to the chapters. You can jump to the ones that you find most interesting to you. Again, I'm Richard Calhoun, Creekside Realty, representing buyers or sellers. Reach out to me with real estate needs or statistical or market questions or anything you'd like to see me do a little different in the presentation. I'm all very receptive to feedback. Thanks for joining. Not seeing any